Good afternoon. Welcome to a new trading video. It's the 6th of March. It's just past 2 p.m. UK time. Haven't been able to do more as I was planning. Microphone issues now sorted out. But I just wanted to share, well, really a couple of things here for today's video, and I'm going to try to be brief. First of all, I just wanted to share that we're still looking at the euro-dollar futures here, and it has been fairly interesting in the sense that there was some movement. First of all, so when there is some movement, there is potential to to make money, which happened, and it isn't also too difficult because the order book was fairly, had some. There was some repetition of different points that happened on the order book, and which made it, it's never easy, but a sort of a way to trade, in a way that you had a clear goal and objective. I'll give you an example now. There isn't so much on the bid side as you can see, but here you can see that on the ask you've got a size at, it's probably 430, so 0430, sorry, here, and you can see that there is some quite important size. We've got 2,000 contracts, limit contracts here, resting orders on the ask size. So clearly that has been here for a while, by the way, and yes, it will. It does imply that the market comes all the way back down to 104.35. And when we look at it today and we're on 108.29, you're thinking, hey, this is far away and never happened, which is true at the moment. So if it does, it will take a while. But the point being that, it was not such a long time ago, earlier this week or, end of last week, we were fairly close to this 104.25, and there was another large size above, and we were in between those two channels of high liquidity and resting orders, and it was really it really, you had two scenarios here. It was to go back down, and this liquidity would, it's not the only reason why the market is going to go down there, but clearly it is there, and clearly if we had gone south, there would have been an obvious sort of target. That did happen, by the way, on the bid side. Sorry, I didn't record it for the reason I just explained, sadly. But it was really, we were in between those two large sizes, up and down, and really we went, happened that the market went north, given the different things happening in the US, which the market regarded as not being positive for the US, and gave confidence in the euro, in the sense that we're looking at the euro-dollar here. But aside from that aspect, it could have happened the other way around, because that is certainly the direction it was taking, and it had been taking for a while. And if you looked at the chart of the euro-dollar, we'd see that it has been sort of continuously going down for quite a while. So we haven't been that around 108.5 for quite a while. So that's, first of all, what I wanted to show, the usefulness of looking at this order book again, and not this particular one, but I like it because it's visual, but any order book. You can see here, for example, 108.20, we've got, that size 1,000 here, or 19. Is it 19, 20? Sorry, it's narrowed. I've made it. There we go. So it's 19.5. So we've got 1,000 contract here on the ask. So you know, if we were to go back down in that direction, this is definitely something I would pay attention to as a level, provided it doesn't withdraw, provided it's still there, provided it's real liquidity. And apparently, if you look at this white bar, it would indicate a good chunk of it, probably half of it, a little over, is coming from the same, entity. So the rest could be a combination of orders, but you also have orders. We look at existing resting orders, and we'll add and pile up if there is some certain level of size. So there's probably a combination of that. So anyway, see, that's an easy thing to spot. It doesn't mean that I'm going to go short now and aim for the 108.19 when we are at 108.29, but it certainly is not completely absurd. And as we go back down, as is the case, gradually here now, I'm going to start looking at other parts which may or may not confirm that I want to go short. So I've got different views of the same thing here, where different sort of time frames. And I'm not going to go into details of them, but effectively, at the moment, apart from that, I've got no real incentive to. I'm looking at the footprint on another screen as well, and I've got no real incentive here to believe that this, is a good time to short specifically now. In fact, it's pretty much flat and going up and down, but ever so slightly. There's no clear direction. We've got some point here of, we've got, I would say, good ground to go back up. You can see all this projected lines. You've got some yellow overlapping some green. That's some weekly volume profile, low volume nodes on the weekly profile plus on the daily profile being projected forward. So there's good ground for going down all the way to a single print. That's a good magnet in itself at 109, and in addition to being 109 as well. And equally, you could sort of find other, areas of interest on the south side, and reasons why it could well be reversing. So anyway, so that's in despite, of course, this huge size here. So I'm just saying, really, we're looking at a combination of things here. I'm not going to go short because I've seen this, but I'm just saying this is here, and this is good to note. Okay, and the good idea would also be to see if we have anything noticeable on the, on the upside, and we don't. But that's pretty much what we are looking at here. As I'm talking as well, you can see that the we are really, as I said, going a little up, a little down, a little. It's not. There's no clear, direction here. If anything, we as I'm talking, we're trading up. But I just wanted to show that this is pretty much the thinking and the things we can sort of help ourselves with. In addition, there is the footprint, which I'm looking at another screen. Potentially some news or some potential economic announcements and other bits and pieces. But that's that's the sort of thing I'm sharing here, is that it's always a confluence of different parts of the order flow that you may want to look at. So this is where we are. This projected low volume nose here was, we could look into it and see where it originates from. But it's quite a while back, in the sense that we haven't been that high. Very simply, for a while. I can see it's all the way up here. It's all the way up here. This is where it's coming from. And you're talking about November the 10th last year. So you see, this is all still valid. This is a long time between November and now, but this is all very valid, projected forward, and now it becomes an area of, it was a low volume node projected forward and becomes an area of interest and an area where we might well go to print volume in, fill in that sort of low volume node with, exchange of contracts and volume. And so you see, regardless of how far back it goes in time, it's always something that we'll keep looking at. There's always the eyes on the back mirror, so to speak, and applying to what's happening now. So that's one thing I wanted to share today. Conjunction, confluence, different parts that we look at and how relevant this is. And in fact, I'll pause the video at the end and I'll resume it a bit later during the day so you can see whether it has gone, all the way to 108.94 and plus, or if indeed we went back to this level I was showing earlier, or if it just traded sideways, because it's also an option. Even though we're trading up now. So the other part I wanted to share, and I'm going to be super brief on that. I've had some people asking me about training. People I know I've trained in the past and who, passed on what they've been doing and been trading using order flow since, and made it really work for them, and talked to other people about it. And I've been contacted recently by a bunch of different people, not on YouTube because I'm not that active on here, but different parts where I am, and I've had requests to see if we could organize some training session either on site somewhere and some city somewhere where there are enough people to justify that, of course, because it requires logistic and renting a room and so on. And also having we could do something online, which of course is easy because you can be behind your computer replicating what we're looking at here. It'll be recorded, so you have the recording afterwards. I'll tend to share all my templates once, not initially, because otherwise it's not used the way it should be used, and people like to do shortcuts, and I don't think shortcuts. There's no shortcuts in here. But once it's digested and understood and so on, I'll share my zero charge, which I'm using template, which really saves you from having to recreate all of that. And trust me, there are years of work in there because it's all looking at order flow parts, bits and pieces, which I'm looking at. But I've tried to make it as visual as possible because it's fully digested and understood. So I don't, it makes sense to me. You can see as I'm talking that, we're going back down now, getting nearer to this 108.20. I'm not trading it, by the way. I'm just wanted to show you it because this is typically the illustration of what's happening. And you could go here, consume the liquidity here, go back up and go back in this low volume node above, which we highlighted. It's not one way or another. It can swing a lot. But anyway, but back to the training, and if something you'd be interested in yourself, feel free to share, feel free to reach out. Again, there are many ways we could do it. I could record some sessions. I don't think it's the best because you can't really interact, and you can ask questions after the fact, and it's on your own. It's nice to be in a room with other people physically, but it's more expensive for everyone. And just doing it online really is the easy way, and it keeps the cost down, and it makes it affordable for everyone. It's still good to have a good number of people in the room for the interaction side of things. Rather than having a couple of people, but not too many either, because otherwise it becomes a bit difficult for everyone to follow, and some people are left a little bit behind and you don't know, and it's hard to gauge. So anyway, I just wanted to share this. Please don't hesitate if you are interested. I've got a dozen of people or so interested as we speak to do something online. It might be two different sessions or three or whatever, depending on how many people are interested altogether. But anyway, it's not something I will charge an extortionate amount for, by the way. The idea is to make it affordable and everybody can learn. And it's a good grounding and putting everybody in the realm, understanding precisely what we're looking at, the order flow, the market profile, the order book, order flow concepts, volume profile, market profile, footprint, type of days, engulfing days, outside days, inside days, that sort of thing, and how this will usually translate as for the subsequent days, and anyway, I'll pause this. I'll just put it back a few seconds once we are clear on the side and another. But you can see the magnet seems to be certainly be more relevant now as we get nearer to it. But I'll pause it, and you'll see for later. I mean, we are 108.25. Let's see where we end up being at a bit later. We see this really becoming nearer and nearer. But you can see it would have been a decent trade had we been short. Again, always all the uncertainty of anything can happen, of course. I'm not saying it's easy to say after the fact, but this was something we spotted at the beginning of the video a few minutes ago. So just to say it's not completely crazy. And if that sort of coincides, this short move with the rest, which it does here, about to here, and looking at the footprint, start to do on the footprint as well, then it becomes less and less foolish. So I'll pause and resume in a bit. So I just wanted to resume this video as I said I would. You can tell that now it's 3:30. So interestingly, that's the level we had, this 108.19.5. We as predicted, it did certainly attract our buyers and sellers, and you can see in that case sellers, and you can see that not the whole liquidity was consumed at all. Consumed like around 200, 183. So it sort of bounced back on that sort of liquidity. It didn't consume it. A little chunk was consumed, and then the market bounced back on it. And by the time it went back up, you can see when it gets back to a certain level, and I don't know if it's related to that level, because if you look at the same level here, okay, we're on the same 108.42. When we get to that 108.42, or even more or less, the actual
Trade 6F5 CME at BMD cell 82
disappears, so it's being pulled off. And it's the same here. It was not on here, certainly not here. We were to those sort of high level, and it started to appear as we gathered around this level here. So if we look back in time, is this something which was designed as such? And possibly it doesn't really matter, to be quite honest. But I'm just saying the whole point here, the whole takeaway was that we looked at a area of potential interest, or level in that case, is more than an area, and of a some level that could well act as a magnet, and it has. Liquidity is pulled off. We didn't consume it. We bounced on it. It sort of acted as a gate, but it doesn't really matter eventually, because had you been in there early, you could have had a short. When we discussed it in the early time of the video, you could have had a short at some point when we were above there, although it was seesawing, but not too far at some point here at least, or here, and well, not here because the liquidity was not here yet, but around here, because there were several occasions when it went back up and down, but around here at this 82345, we could have placed a short, and I've put a exiting the order, having our exit on the level or just above. Usually what I tend to do is put it just above, just in case it bounces, which is what it has done. And yes, it's not huge depending on where you take it, but we had a bounce, we had a second one, a third one. Let's assume we took it somewhere here. Even if we don't take it all the way here, which would have been ideal, but even if you took it here, let's say we took it at 108.30, which is here, and you go down to 108.95, it's it's 10 points basically. Fairly, if I'm honest, when we were around here, fairly, again, it's the confluence of other things at the time which would have confirmed it, but fairly easy, so to speak, to take. And then, it can be looked at in any way we want. It could be a contract, it could be 2, it could be 10, it could be 100. I mean, depending on what you can, the size of your account. But the point being, it's those sort of not risk-free, because nothing is risk-free per se, but it's a risk-free, so less risky, if you like, trades that are good to consider and look at, as opposed to take a full gamble out of the blue that, hey, today is going to go up or down because of the news or because of something else, and it may well actually do so because yes, the markets react to the news and economic announcement and so on. But the point is, it might take a while, and you might be short 20 times before the market reverses back up. So trying to gauge and guess and play that game, it's much harder than finding areas of interest, potentially build yourself. If you've got the opportunity to look at it and there's a reason to think that it could go either way, build yourself a scenario, which is going to be the up scenario and the down scenario, as opposed to anything else. So it's not so much taking apart. And as the market unfolds, as order flow takes its natural course, and you start having a confluence of confirmations and of the volume profile and areas that you've drawn and the order book and some potential level of interest and some other shorter term swing levels you're looking at, and of course the footprint, which I think is super important because you really see the details of what's inside those bars, and then looking at I also have Marimath, which I again do think it's an additional tool to the arsenal, and the volume profile and the market profile, and look at the opening and looking at the intraday and the news, and so all of that combined makes it as likely as possible that we can get nearer to this, we can get into one of those trade where we take far less risks, and when it becomes really worthwhile to take the trade without taking an enormous amount of risk. And again, coming back to that specific trade, if you look at it, and regardless of really the amount of contracts that one would put in there, it and I'm saying regardless because obviously if you put a lot of size, that means you have a lot of capital and much larger accounts, which you can afford to take. It's all going to be in relation with the size of your account. So if you take a risk of one contract and you take it somewhere here and you go down 10 points and you say, hey, if that doesn't happen, but we go giving it a little bit of leeway, but if you were above that swing here because it happened twice before, and then I'm ready to take a hit of 8 points, regardless of the size of your accounts. If you can, the number of contracts you can put in there is in relation to your risk and is in relation to the size of the trading and the target and risk that you're taking to ready to take. So all that to say, even with one contract, we've got somewhere here, we've got our take profit here, if we're going to call it this way, and let's say we've got to stop somewhere here because we went there twice before, or even 3 times, and 4 times and 5 times if you look at afterwards, but we didn't know that at the time, and say, hey, I've put my stop here and I will have lost 8 points. It's I think it's worthwhile. And by the way, the whole logic that I need to take a 1 to 3 risk reward and that sort of stuff, I don't do it. I'm saying you shouldn't. I'm not saying it's not reasonable. But what I'm saying here, when I place a stop loss somewhere, so an exit of my trade, and where I realized that I was wrong. That's not the direction it's going to take, or at least not now. And I'm going to be wrong many times and lose, and give myself some scare before I am right, and eventually while I'm in a trade I won't be able to take another trade and be stuck in the market and going nowhere, and then in the end so I'd not to make that much. I'd rather be quicker and say, hey, past that point I'm wrong. I'm not going to gauge that and put that based on the size, in fact, of my account, or on the fact that I've decided that if I lose 200 or whatever the case may be, then I'll get out, because I'll base the stops and the way I get in, I get out, or the way I get out, take profit and get out, scrape the trade. I'll do that based on the actual order flow. Why? Because the order flow is showing me what the market is doing. The market doesn't care the size of my account. It doesn't know the size of my account. It doesn't know where my stops are. It doesn't care that I've lost 100, 200, 300, 400, or whatever the case may be, or 10, and that's too much for me and I'm getting out. So putting stops and effectively trying to take trades, whatever they are, getting in, getting out, take profit, and so on, based on what your personal risk appetite or not is completely irrelevant to the market. And I've always found people who do that, and again, I'm not saying you shouldn't and it's stupid. I'm just saying what happened will happen regardless of what the decision that you've taken based on your own criteria, which are your own, based on your contract, based on your risk appetite, based on how much money you have or don't have or want to make. So again, that's another reason to look at order flow and trade according to that, because this is real. This is what's happening, whether we like it or not, whether it corresponds to the way we trade, the risk that we want to take, and so on. It will happen. So I would much rather decide on those, make those decisions based on that, as opposed to based on something which is absolutely, nothing to do with the market. I'll leave it here. And again, I'll try to perhaps record another one tomorrow, being the last day of the week, and next week. But again, if there's interest to get trained a bit in more detail and all of that, and understand all of that, and be able to apply it, I'd say let me know. As I said, there's 10, 12 people at the moment, and who's eager to do it at some point, and in a different shape or form. But we could certainly put that in place somehow if there's something you're interested in. Again, I find it's always a way to take ownership of what I do. So if I put money on, some saving accounts, which is not going to give me much return and going to be taxed as well in addition, and so on, and in the end I won't have very much left at all. I'm not taking ownership of anything. It's just sitting there and being stuck somewhere. Or if I put money onto some, in some fund and things are going well, I will, not great, nothing to do with me, but great. And if they don't, I will blame the manager of that fund who manages the money I've put in, and blame him. Here, if you're successful, you are successful thanks to you. If you're failing, or it doesn't work, or your trade doesn't work, or it's all of it is you, not about somebody else, not about an external factor. It's you, and you can really take full ownership of that process. I think it's even if you don't do that as a full-time job, so to speak, and if you rely on your job to and you've got a full 9 to 5 job, and you rely on that to have consistent salary, because of course here you don't know, there's no guarantee. You could make a lot, but nothing, could be negative, could be yes, I'm aware of all of that, but I'm just saying when you do things well, that could be also seen as a good, a complementary source of revenue, and it's fun as well. And you learn things about yourself, and you learn things about the market, and you need to be excited about it to some degree. It's not something you can force yourself into. But my point is that really it's a good. I train some people who do it full time as a job now, and that's all they do, and they do it from anywhere in the world, and they love it because they don't have to go to the office, and they don't need to worry that if they go in a remote place somewhere, they will, and if they lose the job, then oh my God, what am I going to do? Because there's no job done there. They don't have that consideration, and it's great. So they do it for the freedom. And I also know some people who do work and do it occasionally. Some people do it daily, but they spend an hour on it at most, or place a trade, and have they take profit, they stop loss, and so on, and see what happens when they come back. It's not ideal, but they do it. And there's a bunch of people who do use that as a complementary source of revenue. And even if you don't make 20K or whatever the case may be out of it every day or every month, and you make a grand, or it's good. It's something that you do, which is fun, that you took ownership of. It's yours. It doesn't require such a huge investment. You've got data that you need to have, some software which is relatively cheap. Train yourself. I think that's and whether you train yourself with someone or by yourself doesn't really matter, but it's really invest in the time initially. And this is what I'm helping people here. People I've trained in the past. It's not so much that, I've told them something that they couldn't find eventually. Yes, they would be able to find it eventually, but just saving them a huge amount of time. Because all the research that you put in initially, when you try to look for that on yourself, you still need to experiment. You still need to, live it and breathe it and do it. For sure, it still takes time as it is. But if on top of that, we also need to really, start from scratch and go in wrong directions 200 times, it's going to take you years, not months. So, and it still take a while before you get comfortable and get better. And but I'm just saying, it's a realistic. It's not easy, but it's a realistic way to, have an additional source of revenue if it's not your full-time job. Full-time job is great because yes, there is a known part to it, but it's also, and that's why I've been doing it personally, is the freedom thing, because that's worth a lot of money. I can work from anywhere, when I want, where I want, when I want, how I want. Brilliant. Don't need to report to anyone or having to do what somebody tells you to do, and you do it. You're full ownership. Some people choose to do it in addition to something else, and that's fine as well. That's fine as well. And I know people who consistently will do, in bad months they'll make 500-600, and good months will make, between 1.5 and 2K, or just 1K, or sometimes nothing if they go on a holiday because they don't trade. But it doesn't matter, it's cherry on the cake. It's nice. It's Anyway, I'll leave it here. Feel free to reach out if you're thinking of something, want to do something, or I'm not a big outfit. I don't have a prop desk. I don't have there are firms doing that. I'm sure they're great, and you get to trade with other people. But of course, it costs you much more money, and you probably have to do it full time. And i.e., you can't do something else at the same time. Here you can and learn on your own space. So I'm just here to help to put you in the right direction, not waste too much time, and and go and be the rabbit in the headlights here. We avoid all of that, and we go straight to what has proved to work, not only for me, but for many people who do that. And bear in mind, when I say works, there's no 100. It doesn't, the 100% work doesn't happen in trading. You've got, and that's part of the reason why it's hard as well, because you have to learn to lose. So whatever your, the win-loss ratio is, it doesn't matter to some degree, but it's never going to be 100. I'm using Jigsaw, and in Jigsaw I've got a dashboard which tells me what's my loss to win ratio is. I don't know if I can access this right now, but I can certainly. I'll probably do another video tomorrow on it because it's interesting. I'll show you what it calculates for you. But, you know, having said all that, you could be winning 80% of the time and still lose money, because when you win, you know, very little, and when you lose big. So that's something. The statistics are good, but you need to be careful with these, because they are, depends how much, in terms of how proportions, so percentage wise, but also how much when you lose and when you win. So that's probably the most important part. I know some people win, they win to loss. They a winner just at 50-ish% of the time. So you're thinking, well, the first reaction is, oh, well, you lose as much as you win, so it's pointless. No, because when they lose very little, and often, admittedly, but little. But when they win, equally as often, but much more. So on balance, they make money, and I think that's the idea. So anyway, I'll do a video on the stats tomorrow, because it's an interesting thing to look at and consider. Have a good rest of the day, and any question, let me know, and any interest for some potential training, let me know.